Hello there, everyone, and thank you so much for joining us today for one of our weekly webinars here. I'm Sam, and I moderate these weekly presentations. And in just a second, we'll be joined by Patrick Ray, one of our financial advisors, and he is going to be covering some topics related to taking the lump sum or the annuity when you decide to leave your company. I apologize in advance. We will not have time to answer any questions after the presentation today, but I encourage you to still ask away. It's completely anonymous, and I will make sure that one of our financial advisors can address those questions with you either through phone or email after the presentation has ended. Throughout this webinar, you will see some links popping up on your screen. Those will be from me, and they are going to guide you to various resources we have available, one of which will be a calendar link to book an appointment with either Patrick Ray himself or one of our other financial advisors to speak to them directly about your specific concerns or situation. And as a quick reminder, we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors, so please keep that in mind. And without further ado, let's jump right into it with Patrick Ray.
Hello, and thank you very much for joining me today. My name is Patrick Ray. I'm one of the senior financial advisors here with the Retirement Group and with the Wealth Enhancement Group, and we appreciate your attention this afternoon. Today, we're going to talk about pension disbursements and what is involved when we get close to retirement and thinking about how to commence your pension benefit and what options to consider. And after we discuss a number of these things, we're going to talk a little bit about the Retirement Group and what we do to help people in this position. And so on the pension distribution side, you've got a single life annuity format that, for the most part, all plans are derived under. And from there, they have a number of different options depending on the plan for joint and survivor benefits, lump sum options, and then we're going to talk a little bit about the interest rate environment and a look back period for those of the company plans that have that feature as part of their plan. So on the single life annuity side, you've got a monthly benefit, which is an effective payment that the recipient receives for their lifetime, regardless of how long they live. And that payment can be formed under a number of different variations from plans, but it's an effective fixed amount for that retiree's lifetime. And the question is, if you are married, you might consider the joint and survivor option or one of the joint and survivor options that might be available, because there may be multiple of these. And so upon your death, a percentage of this money, it gets paid to the surviving spouse for his or her lifetime. And that's assuming that he or she outlives you. And so this is probably a relevant time to talk about something referred to as a pop-up provision, which some plans have. And it protects the recipient so that if somehow your spouse, who you are insuring to outlive you, does not do so, and if that spouse suffers an untimely death before you do, then the pop-up provision allows you to take advantage of getting your single life annuity payment back intact for the remainder of your lifetime. And so hence the word pop-up, it pops back up to the single life annuity amount, because often the amount of money that is paid to the beneficiary in the event that you choose a joint and survivor option is a reduced amount. And so depending on how much money you want to be paid to the surviving spouse in the event that you die, then it will dictate how much they take away from you. And so it's a good rule of thumb to think in terms of when you get the 50% option. So if you want 50% of that payment paid to your spouse when you die, if you take the joint and survivor option, then you can expect to have them take about 10% of the value. And if you want the 75% option, if that's an option, they typically take about 15% of the value on a monthly basis. And then if you want the 100% option, typically they take about 20% of the benefit. And so if your payment is $2,000 a month, then you can expect to get about $1,800 a month for the 50% option. And then when you die, the surviving spouse would get $900 a month. And if you choose the 75% option, then typically they take about 15%, which is roughly $300. So you would get $1,700 a month, and then they would get 75% of that option as a payment when you suffered untimely death. And then a final option is the 100% option, which takes about 20% of your benefit. So you'd be getting about $1,600 a month. But then if you died, your spouse gets the $1,600 for their remaining part of their lifetime. Now, as the pop-up provision in this particular example, that $1,600 would go back to the $2,000 if your spouse dies before you do. And so it's a unique feature that some plans carry called a pop-up provision. So on the lump sum side, you've got a lump sum option that's an effective actuarial calculation of the equivalent of the total annuity payments that you would have otherwise received in the single life annuity format during your lifetime. And they give that to you in one check. And so the question is how it's calculated, and it's calculated based on some actuarial figures that are being used under the plan rules and the interest rate environment. And typically, we're going to talk about this in just a moment, but it's based on the segment rates that the IRS has. Now, the key takeaway for the lump sum option is to know that as a surviving spouse, if your spouse suffers an untimely death, that you have no death benefits payable under this format. So in other words, if you take the lump sum money out, you have to sign a form as the surviving spouse that says you understand that if your spouse dies, the recipient of the lump sum, you would otherwise not get paid from the company because in typical format, that money goes into an IRA, and then you would be named the primary beneficiary of the IRA. So there are no death benefits payable. But one of the questions that we get very, very frequently is how this lump sum is calculated in most causes or most cases, and more importantly, how to consider or think in terms of what the annuity payment versus the lump sum payment and kind of how this looks. And so if you think in the annuity world and compare that to your mortgage payment, let's assume for a second that we have the ability to afford a $1,950 a month mortgage. And we go to Bank A, and Bank A is going to lend us money at 4%. And at 4%, we're going to take a loan out for 30 years. That allows us to buy a house of $408,500. But if we go to Bank B and we tell Bank B, hey, we'd like to pay $1,950 a month, what can you loan us money at? And they say, we'll loan you money at 3%. And we take the same 30-year note out. This bank allows us to buy a house worth $462,500. So the key to this particular discussion is the lower the interest rate, typically the higher the lump sum payment. So in a perfect world, if you're going to consider the lump sum as a payment option for your benefits under the pension plan, you would want to do so in hopefully the lowest interest rate environment possible. Now, the look back period. This is a unique feature where it's a period in the past during which historical interest rate data is observed. And companies use this look back period to give employees the necessary interest rate information to make a very good and informed decision on what affects their pension values and how their retirement projections look. And so in a higher historical interest rate environment, it might lead to lower lump sum values. So if this look back period shows a higher interest rate environment, you might consider working for a little bit longer window of time in the event that you can hope that the interest rates turn and go south or go lower so that it enforces a higher payment for your lump sum. And so employees should basically be aware of the implications of this look back period so that you can give real-time biases to what's best for you as far as what the lump sum looks like, assuming that the lump sum is the best option for you to take. Now, I mentioned the segment rates here just a moment ago, but the IRS has segment rates that are correlated to 3 different segments. And so what this looks like is this is a chart that shows the 2024 interest rate environment, and you have 3 different columns that represent 3 different segments. And so segment 1 deals with the first 5 years of your retirement, and segment two deals with years 6 through 20, and segment 3 deals with years 21 plus. And so the significance of this is that you are able to see not only what the interest rate environment is doing if you track this rate, which we do very, very closely for our clients. And in addition to that, you understand that the segments have a different correlation to your lump sum calculation. And so typically, the younger you are, the more the third segment is going to affect you because you have more years in your life expectancy after year 20 than someone who is 65 years old, as an example. So what we know is most people have a tough time planning, right? And we know statistically that 74% of the people over the age of 50 don't have a written financial plan. And the key to this is that there's really no excuse for that because firms like us use a complementary financial analysis tool as a way to introduce their services to you so that you, as a complementary takeaway, have the option to work with somebody and test to see if they might be somebody you would consider working with in retirement, especially if you're considering engaging in a partner in retirement. And so the retirement group has been around for a long time. We have a lot of people on staff, including myself, with over 20 years of experience. And we have offices all across the country that can get you close to, in proximity where you're located, so that you have an advisor who's looking out for your best interest. And we take away the knowledge and the specifics of how your 401k plan is designed, and your pension plans and your medical plans, all of which we're able to package into some basic understanding of how it applies to you and your family, so that you can take away and know you're making the best and most informed decision for you and your family possible. Now, I mentioned the complementary cash flow analysis, and there's a few ways that you can go about taking advantage of this. So if you're interested, you can reach out to us at info@theretirementgroup.com. You can call our 800 number at 800-900-5867. You can schedule a complimentary appointment with one of myself or one of my colleagues. If you schedule this using this QR code to the left, it'll give you access to a calendar where you can pick a time that's convenient for you. And then you can also follow us on our LinkedIn pages. And I encourage you to do this because we have some company-specific data and information that's there that is incredibly helpful in the event, especially that you work for one of those companies. So you might choose to follow us on our LinkedIn pages. And so I'll leave you with this. We appreciate your attention this afternoon. We hope you found some value in spending some time with us. But if you're open to or looking for a partner in retirement, we are happy to tell you what we can do under our capacities and our fiduciary responsibility to you as to what's best for you and how to approach retirement in the safest and best way possible. And so with that, I'll leave you for the afternoon. Thank you very much for joining me, and we'll see you next time. Take care.